Hello, everyone. Welcome to the webinar today. Thank you so much for joining us. I am really glad to have you with us, especially as we are coming so close to tax season. I know another year already. If you haven't met me yet, my name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. And as you all are starting to come in, I'd love it if you could put in the chat where you are coming in from. We always love to see where our members are from. So put in your city and state while we do that and while I introduce our speakers. So today we're going to be talking about mastering rental property finances. So we brought with us Adrian Gutierrez, the lead product manager at Ledgre. He specializes in fintech and prop tech over the last 8 years, and he also has built out intuitive accounting tools that drive growth and enhance user experiences. Before this webinar, Adrian was telling me about all of the different solutions that he's helped to design specifically for real estate investors and property managers. So great guy to talk to about tech, especially finance tech. And then we have with us Thomas Castelli, our real estate CPA here. He is a CPA and partner at Hall CPA, where he helps real estate investors maximize their tax savings through a proactive tax strategy. I like that you said proactive. That's what we're going to try to do here today, hopefully. And he combines his passion for real estate investing to help his clients build wealth and minimize their tax burden. So we're going to have plenty of time here for Q&A with Thomas. We are recording this entire thing as well. So if you miss anything, you will get the recording, the slides, and our speaker's contact information as well. We are going to answer questions at the end of the presentation. So please put your questions in the question box, not the chat. The question box is a lot easier for us to track and get back to you with an answer, especially after the webinar is over if we don't get to your question. So please put your questions in the question box at any time, and then we will answer them at the very end. I'm going to hand off this presentation to our accounting and finance experts here. Adrian, if you want to take it away from here, I'll let you get started.
Awesome. Yep. So like I said, like Alexandra said, my name is Adrian Gutierrez. I've been focused on fintech and prop tech for most of my career now. Really started just finding my niche there. And then even my family now has gotten all involved together in real estate investments, buying houses, flipping them, all that. So this is really a problem that is close to heart to solve and close to mind because it saves me time. So I will mainly be relying on Thomas to cover a lot of this stuff. But what we are going to be covering is tracking your income and expenses across your portfolio, looking at those metrics and learning how to understand them, how we're going to create basic reports, prepping for tax season, which is underway right now, right? And then the thing that is most important out of all of it is maximizing deductions. And as we've said already, we'll get to the Q&A section and hopefully get to most of the questions as we can. So anything to add, Thomas?
No, I think we're good to go.
Awesome. So first part, we'll do organizing your finances. And to kick that off, we are going to start with a poll question, which should be popping up on your screen momentarily. So what we're just asking is what's your biggest rental accounting challenge right now? Really just trying to hone in on what we can resolve in this webinar and what we can hopefully hit a little bit harder. I can move this panel.
Great. I'll let the audience here answer a little bit longer. I'm seeing we have almost half of you that have participated, so I'll go ahead and share the results. Okay, here we go. So organizing receipts and records came in first. Oh, wait, actually prepping for tax season came first place. My mistake. But also organizing receipts and records and accurate income and expense tracking not too far behind.
So that pretty much aligns with I think everyone's experience. it's very much divided and it's very much personal, right? So we'll go into the first part of organizing your finances. Tom, do you want to take it away?
Yeah, absolutely. So, believe it or not, when it comes to organizing your finances, one of the biggest things we see as CPAs for real estate investors is the lack of bookkeeping. So, bookkeeping is actually absolutely critically important if you do want to understand your business. And one of the big mistakes that we do see when it does come to bookkeeping is commingling funds. Okay, so believe it or not, if you're running a business, whether it be rental properties or something else, you want to separate your business and your personal finances, okay? And that usually starts with having separate bank accounts. All right. If you have a separate bank account for your rental property or your business, you're going to know that everything that went through that bank account is for your business, okay? So it helps keep things organized, right? It simplifies the accounting and tax preparation because when it comes time to putting together your profit and loss statement, again, you know that all the revenue that came through that bank account and all the expenses that came through that bank account are for your business, or in this case, your rental property. All right. So that's like one of the biggest keys here, in just terms of simplifying your situation is having a separate bank account for your business. And obviously, there's a lot of other benefits here, but the biggest one is organization and avoiding co-mingling funds, which could actually have legal implications too. I'm not a tax attorney. I'm not an attorney, and I can't give legal advice. But if you do commingle funds, it could also pierce the corporate veil.
And I'll interject for 1 second, just so it's not just you talking 24/7 here. I don't want to put that burden on you. But it's even something we've seen on the software side and something that I saw in my time over at another property management software company, was seeing like the division in the landlord journey of when they're starting out. It's very much just like a hectic kind of race to get everything in place, to collect the rent, etc. And it usually doesn't happen. And then when we usually see people kind of upgrade and get to that point where they realize that this is going to really help them, is when you start seeing that initial friction point of them trying to separate the finances, seeing new bank accounts get added into the software. And it was always probably my burden, my team's burden, and even now here, try to solve that edge case of like, okay, we want to help users upload their bank accounts and assign it all to the entity, the property specifically, but we also have to give them the flexibility to realize that it might be commingled. And then it requires, human input, and it takes away a little bit out of that automation. But I will say, like, once you get to the point where you can separate all of those concerns, once you separate that commingling, it makes the tools you use, it makes your process so much easier. And it makes my life easier design for it at the end of the day.
Yeah, 100%. Definitely want to avoid commingling funds. It's a big key here. Now, when it comes time to tracking your income and expenses, you obviously definitely want to keep track of this. When it comes to the income, rent, right? Rent is going to be for rental property owners, is going to be your primary source of income, right? There's maybe some other types of fees you might collect, but at the end of the day, rental income is going to be the number one source. There's also security deposits. Laws differ from state to state, but for the most part, security deposits often have to be held like almost an escrow, if you will, for on behalf of your tenants. So you want to keep them in separate accounts. You don't really want to touch that money. That money is not really meant to be touched or used by you, the business. It's meant to be held in case there's issues where you may have to take that security deposit if your tenant damaged the property, usually above and beyond normal wear and tear. So income, you definitely want to be tracking that. When it comes to expenses, there's a lot of things that get grouped into the term expenses, but not everything is immediately deductible as an operating expense. Okay, so repairs, maintenance, property management fees, legal and professional fees, property taxes, utilities, things of this nature. These are generally going to be deductible in the year that they're incurred. So, for example, in 2025, you have your rental property, you pay your property taxes, you pay your utilities, you pay your accountant, you pay your software fees, all that good stuff. That's stuff that's usually going to show up on your P&L. But then there's something called a capital expense. A capital expense is something that usually is an expense or an expenditure, I should say, that lasts for longer than a year. For example, if you install a new roof on your property, that roof is typically not tax deductible fully in the year that's incurred. It is depreciated over several years. All right. So Capital improvement, again, is usually not going to be fully deductible. Now, that's different than if you were to repair a few shingles on that roof. If you were just to replace a few shingles, or you were to replace a window, or you were to replace some carpeting, usually that's going to be a repair or maintenance expense that's going to be deductible. But major projects, major renovations, replacing major systems or components of the property are more often than not going to be a capital expense. So that's just something to keep in mind there. And of course, there are many different ways to track all of this. Software being the most efficient, usually in today's day and age. All right. So next up, we have cash versus accrual accounting. I would say that 99%, I feel confident saying that 99% of landlords and rental property owners are going to be on the cash basis of accounting. And that just means that you're going to report the income when you receive it, and you're going to report the expenses when you paid it out. Very simple, not that much complicated things have to go on. With the accrual basis, things are a little bit different. It's your income is reported when it is earned, and your expenses when they're incurred. So let me give you an example, right? So say you paid rental. So say a tenant paid you rent for January, right? Or for let's just say they paid you, say it's December and they pay you rent for January. On an accrual basis, you might not actually recognize that income until January, but on the cash basis, you would just recognize that in December in the time when it's incurred. So there's a lot more complexities that have to go around with accrual-based accounting, but luckily, if you own rental properties, you are most likely using the cash basis of accounting.
So maybe I'm gonna ruin the flow a little bit here with the Q&A. But what's the recommendation? Like, should most landlords actually be cash basis? I mean, is there like a, let's say, simple guide to choose between what one you should be choosing when you set your system up, or?
Yeah, you almost all landlords going to be cash basis. It's not only simpler, but I very rarely, if ever, have I really ever seen a landlord on the accrual basis of accounting. Accrual basis of accounting is more for larger businesses that are going to be subject to like GAAP reporting, and that's just the generally accepted accounting principles. Usually, don't see it with rental properties or small business owners. So, if you're a landlord, you are, like I said, you're 99% of the time going to choose cash basis accounting. All right. Sorry. Leveraging real estate metrics. So in addition to being able to track all of this stuff and just be able to see how much income and expenses that your property is running, having good financial records actually allows you to start measuring the performance of your portfolio using some more advanced metrics, such as return on investment, internal rate of return, cash on cash return, net operating income, cap rate, and gross rent multiplier. These are hard to calculate unless you have good financial records, right? How can you tell the return on your investment if you don't know how much money that your investment made, right? Some people just say, oh, well, my bank account's going up. That must be a good thing. And it probably is a good thing if your bank account is increasing, but it does not tell the whole story. And if you want to get more sophisticated with your portfolio and make better financial decisions on how you can optimize that portfolio and optimize really your wealth building journey, you're going to want to have good, clean financial records so that some of these metrics can be reported. I'm just going to touch on a few of these. Cash on cash return is a solid metric. It's basically you're taking the amount of cash that your property generated, or the amount of profit rather, and dividing by the amount you put into the property. So that's a common metric people use to determine how their portfolio is performing. But of course, it's not the only metric. I'd say the most sophisticated and really like the best metric that I see in a lot of cases is the internal rate of return, because it does take into account the time value of money and does allow you to compare investments, whether they're properties in your portfolio or outside of your portfolio, on a more level playing field. But of course, net operating income and cap rate, those are important metrics for commercial properties, which are typically going to be apartment complexes that have more than 5 units, or office, retail, and other buildings like that. All right. So creating and using some basic financial reports, the profit and loss statement, that is probably the foundational report that a lot of investors rely on. It's really quite simple. It's sometimes called an income statement. Basically, it's going to have your income and your expenses. It's going to tell you whether you have a profit or a loss for your business, right? It couldn't get better than that. The rent roll is going to be pretty much the listing, if you will, of all the rents that your tenants are paying you. So that's an important it's really kind of almost like a drill down into the income on the profit and loss statement. Then we have cash flow analysis and operating expense report. So operating expense report is going to tell you what are the percentage, for example, of each expense that you have compared to your income and compared to your overall operating expenses, and can help you compare properties to see if your properties are performing up to standard or if they are not. For example, we've seen reports before where we had one client who had multiple properties in the same market, but their utilities expense, specifically their water expense, was much higher on a percentage basis than all their other properties. And we're like, well, why is that? And they eventually found out they had a leaky pipe in their plumbing. They actually found out about this financially. So if they didn't have their records organized and all these reports available to look at, they would not have necessarily known that this was the case, that they had a leaky pipe that they needed to fix in order to bring down their utility bill and bring it back into more equilibrium with the rest of their portfolio.
It helped their portfolio, but it hurt the water company in that sense
Oh yeah.
because they were winning.
Yeah, sometimes, yeah, not always. The puddle is not always the only way to figure it out. So,
Oh, that's awesome. Cool. We've gotten to this point where we're going to pop another poll question before we jump into the second part. And the second part is, I think, what won out in the first poll, which was how are you preparing for tax season, and how can we help you prepare for tax season? So let's play the game of see to see how confident people are right now when we're in full swing here.
Okay,
It's a
looks
great.
like we reached close to 50% here of participation. So I'm going to go ahead and show the results. There you go.
All right. All right, 55% of y'all are somewhat confident. I like the 25% that are very confident. I would really love to know your secret there, because I just started collecting all my documents and I don't actually fully want to look through them myself yet. So you're very confident on what is today, the 6th of February. That's impressive. All right. Preparing for tax season.
all right. So qualifying as a rental property owner. So 3 to 5 tests. Okay. So there's some things you're going to need to know here. So first things first, for most rental property owners, you're going to end up owning your property either in your personal name or in an LLC. Now, when you own your property in an LLC, the income is ultimately passed through to you, the rental property owner. Okay. So if you have a single member LLC, so you're the only owner, that is what's known as disregarded for tax purposes. And that means is that your rental property is going to be reported on Schedule E of your tax return. Okay. Very straightforward. It's as if the LLC is not there for tax purposes. That LLC is mainly for asset protection. Now, if you have multiple owners, you're going to have a multi-member LLC that's taxed as a partnership. All right. There you'll have a separate tax returns, so a partnership tax return, Form 1065, and you'll receive K1s as the individual partners in there, and those K1s will be reported on your tax return, and you'll pay taxes on your personal tax return based on the results of the partnership. Now, one thing I just do want to throw out there is that you do want to avoid S corporations for rental properties. I'm not going to go into the whole tear down on why that is. But if you move a property outside of an S corporation, even if it's to an entity that you own, it's going to be considered a sale. And if the property had appreciated in value, it's going to trigger capital gains tax, even though you didn't really sell the property, right? So just a quick tip there. Don't want to spend too much time on that here. If you do have questions, drop them in the box, and we'll try to get to them later on. But the good news with real estate, as compared to a lot of other businesses, is that you can generate a loss from your rental property, despite the fact that you may actually be generating positive cash flow. So how does that happen, right? Well, you're going to have your actual expenses that you have to pay, like the property management fees, software fees, accounting and legal fees, repairs, maintenance, utilities, so on and so forth. These are all expenses that actually leave your pocket, and you actually have to pay somebody else. But then there's a non-cash expense called depreciation, which just tracks the deterioration of your building over time, that often results in a loss, despite the fact that it's a non-cash expense, so it only exists on paper, and the fact that your property may actually be appreciating, you still get to deduct depreciation. So very often, you should not be paying tax on your rental income. All right, so that's a general. Now I could go into real estate losses and how they're treated. If you have questions about that, do feel free to drop in the chat box, but I don't want to go on forever on that. A home office deduction. So the home office deduction, if you do rise to the level of a Section 162 trade or business, which basically usually means that you're making decisions for your rental property, you can have a home office, and that allows you to deduct the expenses related to your home office. For example, a home office is usually going to be, let me back that up. To give you some more requirements, qualifications for the home office is usually going to be a room or part of a room that you use exclusively for business. Now, here's the thing. In order to take the home office deduction, you need to actually have income from your business. So if you have a rental loss, which is very common for rental property owners, you're not actually going to take the home office deduction. It will get carried forward to future years. But what's the benefit of taking a home office or having a home office despite that? Travel expenses, or rather transportation expenses. If you commute from your home to your rental property, that is usually going to be a personal commute, and the business miles will not be tax deductible. They won't be business miles. They'll be personal miles. But if you have a home office, your home office is now a place of business. All right. And when it's a place of business, then then the business commute from your home office to your rental property is not tax deductible, or to any other business location. So it's a little bit of a home office. Section 179 expensing. We usually don't see this too much with residential properties, but Section 179 does allow you to deduct certain expenses, or like equipment, for example, in the first year that you have it, rather than depreciating it. So that could be a good expense to keep an eye on. Again, don't see it too much with residential. It's more so common in commercial, but it exists. All right. Startup expenses. These are expenses you incur before your business has been created. And these expenses are not, they're not deductible necessarily when you incur them, but when your business starts up. So once you actually place your property into service, once it goes under operations, and that is limited to a $5,000. Excuse me. Let me make sure I got this right. Okay. It's limited to a $5,000 deduction. And if you do have the remainder of your startup expenses will be deducted over a 15-year period.
The memory, impressive. I gotta say that.
Thank you. I appreciate
you're
it.
impressive right there.
Yeah, I've been doing this for a long time now, so. All right.
Jumping a little bit more into.
All right, so now we're going like we talked a little bit about before, operating expenses versus capital expenses, right? Operating expenses, these are expenses that you have to incur to maintain and manage your rental property and your overall business. Again, these are repairs, advertising. I'm not going to go read each and every one of these off. You could pretty much see what they are. Very common. You can find all of these on Schedule E. Again, really where the main distinction here is that we need to pay attention to are expenses that last for longer than a year, right? That's usually what it is. And those are things like improvements, additions to buildings, equipment, appliances, roof replacements, things like that, right? For example, usually you're not buying an appliance and using it for only 1 year. Usually that appliance can last several years. So that's going to be capitalized rather than deducted all in the first year. right? Same thing with building additions. Like say, for example, you have a house and you add an ADU in the backyard, or you add like a sunroom or something along those lines, or you add just another room. These are usually going to be capitalized and depreciated over multiple years. And that's what gives you that depreciation expense, are these types of longer term assets. Now, one thing I will say in here, here's a quick tip here for tax perspective. There's something called the de minimis safe harbor, and allows you to deduct expenses with that are less than $2,500, regardless of whether they're capital expenditures or operating expenses. Now, the biggest example I could give of that is going to be an appliance. So, an appliance, let's say that a refrigerator, I don't know how much refrigerators cost these days. I haven't bought one in a while, but let's just say a refrigerator's on it's $1,400. That might be expensive for a fridge. I don't know. But that would typically be depreciated over 5 years. That is 5-year property. However, because it falls under $2,500, you can actually deduct that refrigerator all in the first year, thanks to the de minimis safe harbor. So there's a little tool in there. But if you are going to be replacing a roof or major system, like an HVAC system that's over $2,500, that's usually going to have to be capitalized and depreciated. All right. Operating expenses. These are the rules that are typically required to actually deduct an expense to begin with. First, it must be ordinary or necessary for your type of trade or business, right? We see a lot of landlords take advantage of some expenses, right? I'll give you an example, and this would be a capital expense, but it's still nonetheless something that we see. You don't need a Lamborghini Urus, okay, to go drive to your C-class rental properties. It's not ordinary and necessary for your rental property business. Now, if you're a high-end luxury real estate agent, well, you might very well need that Lamborghini Urus to chauffeur around your clients as you show them properties. But it must be ordinary and necessary to deduct. All right, it must be current. That means that you're using it this year. For example, you're going to deduct your 2025 property taxes in 2025. Okay. You're going to deduct your utilities for 2025 this year. Okay. Now, rental related, it's related to your rental business. You're not going to deduct your Audible description probably for your rental property business. Okay. You're not going to deduct your personal TV for your rental property business. All right. Now, reasonable in amount. And again, that kind of ties into number one for me. And that is ordinary necessary. Again, you're not gonna like Lamborghini or another one is meals, right? You don't necessarily need to go wine and dine at the fanciest restaurants, your associates for your rental property business. So it must be reasonable in amount. Okay. Um, Now there's some gray areas in here, of course, but yeah, these are generally what it takes to deduct an operating expense.
You kind of killed the appointment I had later today at the
Oh,
Lamborghini dealership. So it
I'm
kind of
so
hurts my
sorry, man.
feelings,
I'm
but I
sorry.
appreciate it.
All right. So more on repairs versus improvements. This is big. It's a big distinction here, because it's often what people get confused on. Okay. So again, repairs are going to be deductible this year or the year that you incur them. All right. An example of a repair would be patching the drywall. If you're replacing the entire wall on your in a room, chances are that that's going to be a capital improvement. If you're changing the HVAC systems, it's going to be a repair or maintenance item. If you're replacing the HVAC system, that's going to be a capital improvement. All right. If you're replacing a few shingles on that roof, again, that's going to be deductible. But if you're replacing the entire roof, that's going to be a capital improvement. All right. If you're constructing a pool, that's probably going to be a capital improvement. If you're changing the pool water filters, that will be a repair. Okay. If you're converting a garage into a rental unit, that is known as an adaptation, which is under the bar test. We'll get that into a second. That's going to be a capital improvement. Okay. And again, with repairs, which are operating expenses, they are deductible in the year that they're incurred and they meet the criteria we were just talking about. All right. When it comes to um, capital expenditures, they are depreciated over their useful lives. Major components of a building on a residential property, they're typically going to be depreciated over 27 and a half years. On a commercial property, that'll be 39 years. Now, they must meet now for capital improvements, the bar test. It's a betterment, adaptation, or restoration. If it's better improving the property, so say for example, you had a deck, right? And you had rotting wood on your deck. and you replaced it with the most high-end, sophisticated, I don't even know what they're called these days, planks that are tempered and they're going to last for a long time. That's probably betterment because it's bettering your property. It's taking what was there and you're actually installing something much better than that rotting wood, right? You're not just replacing with wood. So that's most likely going to be a betterment, which would be a capital improvement. Adaptation, converting a garage to a rental unit, that's a great example of an adaptation. And a restoration is when you're restoring something to like new condition and back to its original operating efficiency. So, for example, if you took an HVAC system and you completely overhauled it and restored it to like new condition, that will most likely be considered a capital improvement. All right. So, rental property depreciation. So we love depreciation as rental property investors. Depreciation is one of the best expenses that we have available to us because, again, it allows you to have an operating expense on your P&L that helps you shield your rental income from tax, despite the fact that you might be generating positive cash flow and that your property may be appreciating. So we love depreciation. And depreciation is taken on capital improvements, which are assets or components of your property that have a greater than 1 year life. All right. And we went through some of these already. They are subject to wear and tear. Again, your property may be appreciating in value, but your actual building falls apart over time. And we all know that this happens. Okay. You have to own the component you have to have the component for at least 1 year. So if you replace the roof and somehow, some way, you had to replace it again in 1 year, you're not going to depreciate that roof. Or you sell the property is sometimes what happens within that year. And then number 4 is the rental business use, right? So you have to actually be using this property for rent or for investment purposes or another functional business use. If it's a personal property, you are not taking depreciation on your residence or your second home, right? If there's no business use, no rental use, there is no depreciation. All right. Depreciable lives. All right. Residential properties depreciate over 27.5 years. Commercial properties depreciate over 39 years. Now, when you typically have your rental property, by default, your CPA is most likely going to start depreciating your entire residential property, excluding the land, because the land is not depreciated over 27.5 years. Same thing for commercial property, but it's 39 years. However, your property has different components that have different class lives that are depreciated over shorter periods of time, which means a larger depreciation deductions upfront, which means less taxes you're going to have to pay, right? Land improvements, things like pools, decks, sheds, underground plumbing systems, those are depreciated over 15 years. Okay, appliances depreciate over 5 years, and so is most other personal property like computers and vehicles. All right, so these are great examples of property as a lower class life. So when you have a rental property, if you do want a breakdown of the components of your building, you can get a cost segregation study performed. A cost segregation study will break down the components of your property into their various class lives, 27.5 year, 15 and 5 year property. And the 15 and 5 year property is all eligible for bonus depreciation, which allows you to rapidly accelerate your depreciation expense in that first year. So major key there is a cost segregation if you do want to maximize your depreciation deduction. Excuse me. Safe harbors. Safe harbors are a big one. Okay. Safe harbors are certain things that allow you to take certain deductions that you may not ordinarily be able to take. A good example of a safe harbor is the de minimis safe harbor that we discussed a little bit ago in a few slides back, and that is the ability to deduct expenses that are under $2,500 per invoice line item, despite the fact that some of them may actually be capital improvements. Again, appliance is the best example I can give of that. We just went through cost segregation studies, major tool, 1031 exchanges. This is a powerful strategy for real estate investors. So real estate investors, when you sell your property, okay, so look, when you sell a capital asset, could be a stock, could be a bond, could be a real estate, could be real estate. You're going to pay capital gains taxes. Now, with stocks and bonds, as of this recording, you cannot use 1031 exchanges on those, so you're going to have to pay your capital gains taxes. However, with real estate, when you can use a 1031 exchange to defer your capital gains taxes, by investing the proceeds into another property. So, for example, if you have a single family rental, it appreciates by $500,000, and you're like, okay, great. That's great. I want to sell my property, but I'm going to incur a huge capital gains tax. You can actually sell your property and acquire another property within 180 days, and you will defer your capital gains taxes. And you can keep doing this over and over and over again. And if we have time, I might tie together the big picture of real estate investing for everybody here and how everything fits together. The home sale exclusion. The home sale exclusion is actually not really used on rental properties. It's actually used on residences. So if you live in your property for any 2 out of the last 5 years, you can exclude up to $250,000 or $500,000 of capital gains taxes if you're married, filing a joint return using the home sale exclusion. So for example, if you bought a property in 2022, you lived in it until 2024 and you sold it, you would be able to make those exclusions. Now, this can have a rental element in it, kind of. Okay. So again, you can use this if you lived in the property for any 2 out of the last 5 years. You also have to have owned it for those 2 years as well, for at least 2 years. But what you can do, if say you have a primary residence, you live in it for 2 years, you move out for whatever reason you have to move out, you move to another property, and you can rent that property for 3 years, and then you could eventually sell it and still lock in that $250,000 or $500,000 exclusion. So those are some powerful real estate tax strategies. All right. Now, when all is said and done, for rental property owners, you are most likely going to file your taxes on Schedule E of your Form 1040. All right. And you're going to have listed on your Schedule E is exactly what you see there. You're going to have your rents received. You're typically not going to be receiving royalties on your rental properties. That's more for like oil and gas investments or perhaps other types of passive investments. But you're going to have rental income. Then you're going to have your expenses. If you look here, numbers 5 through 20, those are all operating expenses. Again, immediately deductible in that year. Your depreciation expense you see on line 18, you're gonna have a depreciation schedule, and that's where all your components of your property will be depreciated. And every year you're gonna have the depreciation expense, and that's gonna show up on line 18. All right. So what you're gonna want to do is to make sure that you're reporting all of your rental income so you don't get in hot water with the IRS. They definitely want their money. And also making sure that you're claiming all the deductions that you're entitled to reduce that income or the amount that could be taxed to the first extent. You want to keep all your receipts and invoices. All right. And software can help you do that. Okay. You're going to want to make sure you document your expenses. Again, you do want to keep a separate bank account so you have all those expenses in one place and you could track them easily. You want to categorize them as you go. I see this all the time with clients. They'll have their proverbial shoebox full of receipts or they'll have their accounting software and they just won't use it. And then the end of the year comes around and they have to sit there for a number of hours and go ahead and reconcile everything that would happen throughout the year and hope you remembered what happened, right? So by categorizing it as you go, could be on a weekly or a monthly basis, helps you keep everything organized. Again, we just went through Schedule E. So Form 8825 is actually found on partnership tax returns, and that is where rental properties are found or reported on your partnership tax return. And again, your share of the partnership's income and losses will be on your K1, and you'll actually report that K1 on Schedule E, page 2 of your tax return, which just has like one line that you have to really worry about. So when all said and done, summarize this, you want to track everything so that you can report it properly in your tax return, not get into any hot water with the IRS, and make sure you're getting all the deductions that you're entitled to.
And so we'll launch this last question before we jump into it. To start hammering in on what you're currently using to keep track of your expenses, of your income, etc. I mean, it really comes down to, at the end of the day, the easier that you get set up, right, with whatever works for you, whether it's software, whether it's spreadsheet, whatever system that is going to help you keep doing it every day or every week or however you're going to reconcile. It's going to make your life easier come the end of the year, make your CPA's life easier as well. And and hopefully get rid of that shoebox that has receipts, because that's just horrendous at the end of the day to have to go through that all. And I think
Yeah.
I know what the response to this question is going to be, who's going to win. So let's see if I'm proven right.
Wait, you have to tell us your guess first, though. No cheating.
It's going to be spreadsheets. It's always spreadsheets right now. And it's because I use it in my personal life that I know how easy it is to spin up a spreadsheet, really arm it up and be like, yeah, I'm going to keep track of it. And then about I don't know, I give myself usually like 4 or 5 months, and then I just stop updating it, because it's just random. So
It is very manual, but it does work. I mean, if you do it. So
if you do it,
if you do it. Okay, let me go ahead and end the poll and we'll see if Adrian is right.
I win. I already know QuickBooks is an accountant's tool. I think most of the landlords and property owners I've spoken to, they use it begrudgingly. And outside of that, it's always spreadsheets. Always spreadsheets.
Yeah, I would have guessed that one too.
Yeah. So perfect. So here's my response to spreadsheets. I got into it a little bit. They work, they're functional. If you stick with it, it is fantastic. There is some automation you can do there to make your life simpler, everything like that. It just has a learning curve like anything else, and it requires a lot of your time. And I mean, that's the thing that we all are vying for, is where do we put our time? So my response to that, especially as it comes to this problem set, was why my team and I set out to build Ledger. So this has been our focus for a while now, is just building really just a very easy all-in-one accounting software for rental property management. We're really focused more on, smaller time property owners, and independent landlords, kind of just honing in on the people that aren't at the huge property management company level, and making it as simple as possible to not give yourself a headache as soon as the end of the year comes around and tax season is looming, and make your life easier during those months as well, to see how you're going, see how you're doing in profit and loss, everything like that. I will caveat this with, we feel like we've gotten to a really good state with where we are, and we just recently launched. And there's a lot of things that we're going to learn, a lot of things that we're going to improve on, but I feel like we've launched in a really good place to help a lot of people out this tax season. So right now, with the users that have been helping us build it out, test it out, we've really found that we've been able to hit on just two key things right now, is just simplifying the accounting, pulling in all their payments, pulling in their expenses from their bank accounts, from our partner, Anago, who is a property management software company, that is just really focused on just the same audience that we are as well, and making the management side of the property easy. We're making the math more easy and streamless, and just really simplifying that, taking it out of your hands of having to put things into an Excel sheet or anything like that, and just coming back to you and being like, here are your transactions. We've already been able to either categorize them automatically and put them where they need to go, or we need you to come in and do a little bit of work, but not a lot of it. And then real time insight, right? Taking all that income expense, and as Tom said earlier, once you have everything really just where it's supposed to go, your income, your expenses, what entity it's going to, what properties they're going to as well. That really builds the base for financial reporting. And that just really takes you to another level, right? Of seeing where you're at and where you can go. And then at the end of the day, right? With those reports, it's just removing any of that stress. So right now we focused on 3 reports that I'll show you, that we feel like are the cornerstone at the moment. So as I started mentioning, our problem set that we solved is bringing in the structural data. So what entities you have, whether that's you personally, whether it's an LLC, whatever, importing that alongside the properties and what they belong to, who they belong to, et cetera. And then bringing in your income, your expense, tracking that, assigning it to where it needs to go. And like I said, we have really 4 methods of bringing in your transactions right now. If you're an Inago user, that's bringing over your entire portfolio as it relates to what we need automatically, and keeping that up to sync, and doing that, every day, and notifying you whenever you need to come in. Same thing with connecting bank accounts. I'll give the little trick though. We didn't want to overload this space, but you can actually go ahead and connect your credit cards and everything like that as well, and have all those transactions getting imported. And if you're one of the landlords that has really gotten rid of that commingling of funds, this is going to make your life instantly easier. You're a landlord, or you're like me, which I'm going to show you in the product in a minute, that decided to connect his bank account that stretches across 4 different bank accounts. You're going to see the headache that I have with over 2,000 transactions, and why they don't fit where they need to go right away. Or for the landlords that have been using just spreadsheets, that is what the upload CSV and Excel file button there does, is it's going to pull all that in as well. And like I said, we focused on 3 reports that we feel like are the cornerstone to people right now, and that's profit and loss. That can be across your whole entire portfolio. That can be for an individual property that you can generate that for. It's one click after you select the date range, and then Schedule, and then Form 8825. So I will speak about what's coming soon to Ledger, but first I want to show you Ledger really quickly. So I'll go ahead and stop sharing there and switch over to Google. So you saw a little bit, but I went ahead and I've already signed in. I'm going to run through this really quickly, but we're here. We're live at Ledgre.ai. You can access it. It'll take you to the app.ledger.ai. But like I said, for those that are already handling this with CSVs or Excel files, I'll just go ahead and create some mock data. And so we'll ask you to map your property name, your property address, the units you can include here for that. Right now, I'm just going to keep it simple, show something off. Going to exclude property name just because I think not a lot of people have it all the time, but we solve for that too. So this comes in. So you'll notice that it goes into unmap. And the reason why is the common use case is most landlords aren't knocking down what properties belong to an LLC, to the personal name, what have you. So that's the first part of the hierarchy that we want. And we keep it really simple. We just ask for the entity type. I'm going to go ahead, throw in LLC, and throw in an entity name. And I'm going to assign 9 properties right now to this. And I'll keep the rest of these guys unmapped. So as you can see, these all got thrown into this entity, JFS Studios, LLC. You'll see why that's important in a moment. But coming over, our next screen is asking for your accounting method and your bookkeeping start date. So while most landlords are cash, right? And we'll go with Thomas's number of 99%, we didn't forget about the 1%. So you are free to select between cash and accrual. Cash, as Tom mentioned, is really just based on when you received that payment or when you incurred that expense. Accrual, right? It's a little bit more complex, and you can actualize it for when you're actually earning it. But for those landlords, you'll see that there's functionality around how you split those across, how you split transactions across dates. We do accrual flags just to flag any potential lump sum payments that you receive that you don't want to book, on that date you received them, and let you take care of that. And then your bookkeeping start date, whether you're inputting from a file, a spreadsheet, whether you're bringing it in from Plaid, or whether you're bringing it in from Inago, or any other partner that we might have in the future, we will only pull in those transactions from this date and forward, right? So if you want to start clean with this year, you're going to go ahead, you're going to select January 2025. So that's all set. We'll go to the next screen, and this is our onboarding process. It can be as quick or as long as you want. If you want to get it all set up and be good to go as soon as you drop into the product, I recommend you spend a little bit more time here. If not, we understand. So I'll do one thing here. So right now, I'll just go ahead and upload a spreadsheet. We accept a lot of different columns here. At the end of the day, if we don't have the column in our database, we'll ask you to map. Right now, I already know how the system works, so I threw it all in. And so we can handle a lot of transaction volume. But as you can see, when we need a little help because maybe you're missing a category in that transaction in your spreadsheet or from whatever source you brought it in, you'll be able to come in here and depending on whether it's an income or expense, assign, right, what category type it is and what property it's going to live at as well. And that can all happen automatically. You can bulk assign them as well to where they need to go if you want to throw them all to one specific property. And that will all update, and then you'll just go through and you can start mass assigning expense or income category as well. I see a smirk from Tom because I think the other day when I demoed this to him, it wasn't working. And that was because I didn't push the right update, but it is now. Outside of that, on this screen, what I did was I pulled in my transactions from Plaid. So my bank accounts, the four. You can see there's 2019 transactions. Most of these are personal, pretty much, I think, all of them, because I do not commingle the funds. But as you can see, this has pulled in most of my other and tagged most of my expenses or income as other because we are mapping, we're mapping automatically the categories that are coming in from your bank and all the data that comes in from there, merchant name, etc. In the background here. And we will be exposing more of that information. I think that's important to show merchant name, description, and everything like that. For right now, I'll go ahead and I'll show off this one, what it looks like. And so I signed that transaction. And so what this actually does is we pull in the description, right? Rent and utilities payment. So this one comes in because this is a personal payment and not a rental property payment. So it's not actually income for me. And then we also track duplicates as you saw on that bar, but I'll go ahead and just throw these all onto one property here. And so throw them all there. Like I said, we can handle a lot of transactions. It's really fast. And we'll go into the fun part now, the dashboard here. So once you come into here, this is your dashboard. This is where you'll log into, see everything that you have. We'll connect you to the blog. These are our action widgets, right? If you have new properties coming in from PMS connection, from something we've detected in the bank account, what have you, we'll let you know there. Once you have new transactions also syncing every day coming from one of your bank accounts, your credit cards, what have you, it'll also show up here and you'll be able to go and map those. So that process I just showed you. And then just a little sneak peek there. There's the profit and loss that will let you see every single time you log on to this dashboard. Like I said, you can go see it for your whole entire portfolio, or you can start doing it for your property specific ones as well. I won't go through every single piece here, but this is why we have that hierarchy. So if you have more entities, the properties will be nested under them. Or if you have all properties in one entity, you'll have that list and you'll be able to see them all broken down on an individual one. The last piece to kind of show off before we get into the crux of it all is we let you have a lot of control over how you want to slice up your financial data, search for anything you want to, export it how you see it on your screen, your date range, apply any filters. So you can just really drill down. And if you don't like the grouping, right now we group it by entity and property. But if you really want to get to where you're just playing with all your data, you can get to the point where you have no groupings and it's just all your transactions. So we really formed that general ledger module of accounting so that we can form that basis to go really hardcore into reporting. Right now, we wanted to get the three top ones that we think are important for this season out. And that's our profit and loss, which, as you see, is sometimes called net income as well, Schedule E and Format 825. So I'll go ahead and I'll just generate this Schedule E report for 2024. And I'll go ahead and do it for the full portfolio or full report, which means my whole entire account. And so we'll throw it into here. And as you can see, this is the 10th Avenue property, which I assigned all of my transactions to. And we match every single category that you'll find on that Schedule E. We do not provide depreciation expense or depletion at the moment. As Thomas was referring to, there's a lot of items that can go onto that, and it's a fixed asset schedule. It applies different year. the time value, everything like that. So we shied away from it for the moment. That's something that most people are already tracking and or working with their CPAs to keep track of how they want to account for that in the year. And we don't want to confuse anybody if we did it wrong at this moment. You can export this and it'll be fully formatted. We will be putting a video here of how to pull this information over and do the schedule yourself. And it's available for your whole entire portfolio, or you can drill down into one specifically. The last thing I'll call out, and then we can get into the questions or anything else that Tom wants to cover, is we are built from day one to go ahead and give access to additional users. So right now, we'll go live with this here really soon once we start seeing an influx of people. But once this goes live, you'll easily be able to invite your CPA or a sub owner. So I don't know, your partner, your family member, whomever is needing access to this, your property manager, for example, into the workspace. And they'll be able to, if they're CPA, just view the data, use it for how they need to use it, or if they're sub owner, be able to edit it. So multiple user access control is there from day one. And yeah, I mean, I think we try to simplify this as much as possible and build off on the right foot. And the only thing I'll mention other than that, won't go back to the slides for the moment, but right now, coming soon, what we are focused on here until April, the tax deadline is there. We'll be focusing on probably building a balance sheet, helping categorize more automatically and faster so that you have even less to do. And then just making sure that we're listening to any and all user feedback, resolving any problems, and just really learning as much as we can and providing as much of the effort and support. So that's the big focus for coming soon for Ledger. And like I said, we're launched and we're free through tax season right now, and you can find us at Ledgre.ai. There's no need to put in credit card, anything like that. You're free to sign up and have easy access to a tool built for you.
Great. Thank you so much for that and going through the demo. Some people were already asking, can I see it? I'm like, yes, he's going to show it. I'm glad you did that. That's awesome. Really great features there. I'm going to go through the Q&A just in order. If you all have questions, I've been trying to tell you in the chat to put it in the Q&A box. So go ahead and do that if you have any questions, not the chat box. Thor is asking, what is the IRS difference between new roof and repair?
Yeah, that's a great question, and it's a bit of a nuanced question. It depends on to the extent of the repair that you're making to the roof. I mean, if you're doing substantial repairs, there's the betterment, adaptation, and restoration test. That's really what those tests are for, to help you kind of step through and figure out whether or not it's a repair or maintenance. Like if you just want like a quick like general overview, if you're doing substantial overhaul, so the roof, it's most likely going to be capital improvement. If you're just repairing minor parts of it, it's most likely a repair.
Right. Mark asking, is there a minimum amount to capitalize items?
There is no minimal amount. However, having to capitalize every little thing that could potentially be a capital improvement can get tedious, which is why we have the de minimis safe harbor, which allows you to deduct a lot of those smaller capital improvements.
Nice. Marcia asking, do capital expenses go towards your basis and other are just deductions?
Yeah, so capital expenditures do typically increase your property's tax basis or cost basis, and then is depreciated over time, which when you take depreciation deductions, you're actually reducing your cost basis.
Great. She also asked what elements go into calculating IRR.
Yeah, that's a mouthful. That's a whole topic unto itself. Usually what's going to happen, the entire point of internal rate of return is to set a level playing field. So you can look at compare investments that might have different timing of cash flows. Like the best way I could say it is going to be, you're going to have a discount rate and you're going to have multiple cash flows. You're just going to have an initial investment that's going to be a negative cash flow. Then you're going to have projected cash flows over a period of time, and you're going to discount that all back using a discount rate. Bit more complex than we probably have time to go through here today, but there's plenty of resources out there online that could help you get a better understanding of internal rate of return.
Right. Amir asking, what are some of the examples of Section 179 deductions for rental property?
Yeah, so Section 179, we often see this on commercial properties. There's a lot more opportunities for Section 179. Like, for example, you could deduct HVAC systems using Section 179. Certain roof components can be deductible using Section 179 on commercial properties.
Okay. Casey says, LLC, can one open it in any state, regardless of the state of the property's location?
Long story short, you can do that. However, most of the time, you will have to actually register that LLC in the state where the property is located. So that's why in many cases what you'll see is people creating those LLCs in the state where the property already is.
Right. Amir asking if you have several expenses that each is considered diminious. I don't know if I said that right. Diminious expenses less than $2,500. However, collectively they exceed $2,500. So is the annual deduction capped at $2,500 per year or per item?
It's actually per invoice line item. So you could theoretically have an invoice with a dozen expenses on it. And as long as each one of them has its own line item that's under $2,500, that's usually how you're going to be able to deduct all of them. So,
Okay. Yeah. Casey also asking for deductions if they can deduct if a family member helps with the repair and maintenance. How do you deduct that?
well, if you pay your family member, then you would deduct it as like a labor expense. Yeah.
Mm.
If you don't pay them, you're not deducting anything. It just helps you out. They just did you a favor.
They just did you a favor. Yeah. YT saying resident managers unit living space. Is it considered a home office?
No, that's usually not considered a home office. I'm trying to actually think about how the best way to deduct that. I forgot off the top of my head if it's like if it's a rent, if it's like reducing of, I think it's compensation to them and it's a deduction for you, actually, believe it or not.
Gotcha. Part of the job, I suppose. Marcia asking, do capital expenses go towards your basis? Oh, I already answered that one. Sorry. David asking, what renting your home to your company for 15 days? What's the IRS rule and your thoughts?
So that's the Augusta rule. And the Augusta rule allows you to rent your property for 14 days or less. So less than 15 days, um, without having to pay taxes on it. Without having to pay, it's basically you could rent it out. Like I can rent my house out to Adrian for 14 days and not have to report the rental income. Some people use that to rent their property to their business for like a retreat or something like that. It's often abused. But for 14 days or less, and then they get the rental income tax free and they get a deduction for their business. That's pretty much how it works. It's illegal, you could do it, but just make sure you don't abuse it.
Good advice. David asking if you replaced exterior stairs on rental property, can you deduct in the same year?
It's most likely a capital improvement.
Mm-hmm. Diva asking, how much is this software ledger? So we said it was free through tax season, which is amazing. So, I mean, no harm in trying it out. So after the tax season is over, is there a monthly charge or anything like that, Adrian?
So right now we are planning on a monthly charge after tax season. We're working on a couple strategies, nothing super set in stone, but what we're thinking, it will be based on how many doors you have. But the max cost I think that we set out on is $45 a month. So
Right.
it's going to be super affordable, super cheap. You won't have to really think about it.
Great. Thor asking, is there any cross-tracking of input info or sale of data? I think that's for you, Adrian.
So right now, we're working towards it. Yes, right now it's very much just reading off your transactions. One of the other coming soons that we're prioritizing is bringing in mortgage data, any other loan data that exists, interest rates on those on your cards, etc. And then being able to help you track that and just reconcile all of that as well. But at this moment, it's more of a general ledger system.
Okay. Casey asking software. Is SW available to iPhone app to supplement inputs, etc.?
I believe that's for me too. Right now, we don't have a dedicated mobile app, but the whole entire website is mobile friendly. We made sure to build with that adaptability and accessibility. So,
Great. Also for you, Adrian, does your software include monthly billing for tenants?
so we do not facilitate payments between property owners and tenants right now. So that's stepping into the property management
Mhm.
of it all. But we will track that information over from Anago, who is our main partner right now, as
Mhm.
well as those in your bank accounts. But we do not facilitate payments.
Great. Yeah, Inago, I'm sure some of you have heard of them by now because they've been our partner for a while. They do have free property management software. Some fees you'd pay for, or the tenant would pay for the online rent payment, but it's very low. And so, what Adrian's saying, you could take that data from Inago or a different software, and it could still be pulled into Ledger, even though Ledger doesn't do it themselves. Okay, Gail saying, I use Reps Tracker and Mic IQ, and I feel like I'm spending my life just documenting. Is there a quicker way? So I think that's kind of what we showed, right? The ledger pulling in the data. Do you have anything to add to that, Adrian?
No, I mean, like I said, it's all about where your transactional data is housed. If you're keeping it in a spreadsheet, if you have your banks and you're not commingling funds across, your bank account usage, your credit card usage, however, then, it makes your life a lot easier. And that's what we're really built for. At the end of the day, if there is, commingling, we'll help you map that correctly. But I mean, my recommendation is find something that works for you. I am biased, right? I really enjoyed working with Anago to design this out. And I feel like they have a really great system and make property management easy. I would recommend finding a tool that actually saves you time versus one that you feel like you're spending your whole entire life in, or two,
Yeah.
if I understood that correctly.
Yes, that seems like a pain. Nori was saying here, is there a software that I can just buy and not do monthly subscriptions? So at least I can say most softwares lately, they're all monthly, but I know like Inago at least is free, and you have, the free time to use during tax season Ledger. So anything to add to that, Adrian?
Might have to take it back to the team and figure out if we want to accept that for a few people. But I would say one of the benefits of going more of the monthly route versus what I think is what I grew up in, where you could just buy software full out and own it, is you lose a little bit of that reasonability to maintain it or improve it, right? When someone just buys it outright and you're not dependent on them retaining and pushing you to keep on improving your software and everything like that. So that's my reason for why we went that route. So
Yeah. Yeah. Let's see. It says, is the website working? They typed in www.ledger.ai. So no, that should be working just fine.
yeah. Well, now you've made me concerned.
Yeah. No, it seems to take me. Oh, it's taking me to a coming soon page. So
Let me.
I think they might be right on that with the www perhaps in front. So take
That
out
might be it.
www. No
Yep.
www, and it should take you to it. Someone else asked why .ai. I know that's something popular I've been seeing lately. It's more of a trend versus .com. Um,
I would love to
and
say it's a
yeah.
trend. We will be utilizing some machine learning models and everything like that to help categorize. Um,
Mhm.
but it's honestly because the person that had Ledger.com wanted a lot of money for us to be able to have that domain name. And I believe it's just a GoDaddy thing that's dead on the internet at the moment. So that's one of the reasons we went that route.
Yeah, that definitely does happen. And nowadays, I think it surprises me that there's any URLs in existence that have not been taken at this point. All right. We did answer this earlier, but maybe worth reiterating if they can give their CPA access to Ledger, and I think that's coming really soon, right?
Yes, we are.
Yeah.
We're waiting on one change, and we are built with that. in mind. So as soon as that change goes live, you'll be able to invite them and they'll get access to that workspace.
Right. Bruce saying, is there a category in Ledger for real estate education and air travel, hotel expenses for the 6 conferences that we attended in 2024?
So I think the Schedule E, and Tom, you can correct me if I'm wrong, that might be applicable under like the travel category, or if you don't find one that's directly applicable, you have the other list, and then you have to provide that list to the IRS, right, of how you're justifying that.
Right.
So, and then education, I'm not sure if there's a direct category on the Schedule E or Form 8825 that is just education, but I might be wrong.
Wow, 6 conferences, that's quite a lot. So I'm glad you're out there learning and networking. That's awesome. Okay, D, Simon, if you rent your home on and off on a seasonal basis, but you don't rent it one year, do you still need to claim the depreciation for that year? That'd be a Thomas question.
Yeah, so they're saying they don't rent the property that one year.
Yeah.
Yeah, that's a good question. It's honestly a tough question because sometimes, because we would probably report it on your tax return and just have no rental income for that year, perhaps, and just have, well, it depends. Were you offering it for rent? If they were offering it for rent and nobody rented it, the property's still in service. So technically it's still a business. You just didn't get any customers. So you just have a loss for that year. But if you took it out of service, you maybe wouldn't report. It depends. It just depends on the circumstances, actually.
Yeah. Okay. Well, we will maybe see if you want to give any more details. We can maybe follow up with you after the webinar. Also, Greg asking, we have a 2-member LLC for a rental property. My CPA says he will provide us with K-1 forms for our personal tax prep. How is the K-1 different than a Schedule E?
Yeah, absolutely. So the K-1, so with a partnership tax return, the partnership is reporting the income, expenses, and some other details to the IRS on that partnership tax return, but the partnership's not actually paying the taxes. You are, as the individual partners, are going to pay the taxes. So Schedule E is reporting the income and loss direct income expenses directly on your 1040, whereas the K-1 is passing through that information to you via the K-1, and then that's reported. So it, more or less the difference is the K-1 is your share of that partnership's income and expenses, whereas the Schedule E is directly reporting that property on your taxes.
Okay, thanks for clarifying. David asking, are photos, this is for Adrian, are photos and voice automation, can those be used for software entries?
So voice is no. I think that's not something I've heard before. But we are working on hopefully supporting some photo just reading to be able to like upload receipts and everything like that. I didn't show that, but on the transactions, you are able to upload all your files if you have those on your phone, if you have those on your computer, etc.
Great. Okay. That would be nice. He says talk and type to clarify, but so like voice to text kind of things. Maybe a future feature you can consider. Um, D. Simon also asking if you took possession, a title change on a property in a divorce that was rented on and off seasonally and yearly over 20, does the 2 out of 5 exemption rules start with the new sole owner, or does the 20-year joint ownership apply? That's a very highly specific one.
Oh,
So
oh,
if
this
you
is
want
for
to
me.
answer this, Dom, offline, you certainly can, but it looks like there was
Yeah.
definitely some switching of ownership that might have changed.
Yeah. Yeah, I
Mhm.
wouldn't want to tackle this right here.
Yeah.
It's a little bit of a thought that I probably have to brush up on a few things to give you a correct answer there.
Okay. Well, we can definitely connect you to Tom. So Nori asking if the wife of the rental owner is doing the cleaning and the gardening and the managing, but now we want to charge for those services, could that be in the management category?
Yeah, so you typically would not charge for those services because if you charge your wife for those services, she would be reporting income and then you'd be deducting it. So it'd be a wash. So it'd be like, you just wouldn't go through the hassle of doing that. However, what some people do is they do separate out. They do have a separate management company for their rental properties, and in that case, your wife might be getting compensation from from that property management company. So you could do that if you have a separate company. But again, like if you want to keep things simple, you don't have to do that. In most cases, we really don't see that happening too often, but it's possible.
Okay, great. I'm checking the chat to see if we missed anything there. Lillian asked, is the IRS enforcing the filing of Form 1099 NEC for contractors rendering services above $600? Some of my contractors do not want to provide their TIN or EIN or even fill in a W-9 form. They just want to provide an invoice. Any advice on how to approach?
Yeah, this we see this every single year. So I'm not surprised to hear this question. A best practice is to get them to fill out the W-9 either before they start work or before you pay them. Once you pay them, they're gone and you're never gonna see them again. That's because when you file 1099, the IRS, you're reporting to the IRS, hey, I paid so and so construction, you know, $10,000. Now they have to report that on their tax return. If they do not report that on their tax return, the IRS can easily audit them. So that's why they want to avoid it because they don't want to report on their taxes. So, as a best practice, again, you want to get that W-9 filled out prior to paying them. So that's as for the penalties, like, will you get caught is really the question. But if you do get caught not issuing them the 1099, you could be subject to penalties. It's like $50 per 1099 missed, and then there could be additional penalties on top of that if things escalate. So best practice is just to get it done early to avoid all that.
Mhm. Okay. Kabuki was asking, this is for Adrian. Can you connect, say, a Lowe's or Home Depot credit card, or can you only do like certain credit cards to connect to the software?
I don't want to misspeak, so I have to check that. But if it pops up on, we're using Plaid to house those connections. So if it pops up on there, which usually it should, have great coverage, we should be able to pull that in. So happy to, if you want to connect with me, happy to try to test it out. So,
Okay. Yeah. On that note, we will be sending everyone the contact information for Adrian and Tom. We're going to be sending you all the recording as well, and the slides. So, yeah, so that should answer one of the questions in the Q&A. And then Nori says, thank you for answering my questions. If they are filing taxes separately anyway, then isn't it okay for the wife to get paid? So this is back to the question about the wife doing the cleaning and gardening and whatnot, management. So Tom, if the couple is filing taxes
Okay,
separately,
sorry. Um,
then
they're talking about getting paid, the management company. Is that what the question is?
so it's like the wife, if the wife does the cleaning and the gardening and the management, and the wife and the husband are filing taxes separately, then isn't it okay for the wife to get paid by the husband, I guess, to the company?
Yeah, that's
A
a
little
good question.
tricky.
That's a good
Yeah.
question. Yeah, I'd have to think about that a little bit more. I don't see, that's a situation that I have not seen.
Mm,
So I'd have to think about that to give you a correct answer. I don't want to lead you the wrong way.
okay.
Um, yeah, this is a little bit more complex than I'm going to be able to answer right now.
All right. Well, that was our last question anyway. So we left the hard ones for last, so you can follow up with Tom. I will be sending everyone the email tomorrow. We'll be sending you Ledger's link so you can access their software. Again, it's free for tax season. Definitely take advantage of that and explore it a little bit. If we didn't get to your question for some reason, we will be answering it offline. And the slides and recording, all that is coming to you tomorrow via email. So look out for the email from me. And also, we will be including an invitation to our next webinar next week, which actually plays nicely into this webinar. It's about how to determine whether you should sell your rental property, if it's actually how to do an actual cash flow analysis to find out if it is actually a profitable property. If you're using Ledger, it should be pretty easy to probably find out if it is something that you should be selling at some point in time. And we'll go over that and some 1031 exchange options if you did want to sell. So please take the exit survey as you leave. Adrian and Thomas, you did such a good job today. I mean, you covered so much information, and like someone said it in the chat, and I think it was a perfect description. It's very concise. So appreciate that as well. You had a lot of information.
Thank you.
My
Thanks
hat's
for
off
having
to
me.
Tom. He killed it. Thank you.
Yeah,
Appreciate it.
Tom. So good,
Thank
so
you.
good. All right, we'll see you guys next week. I'll be in touch. Take care, everyone. Bye.
Bye now.